My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other when people want to make friends, I'm just trying to make a little money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. You always hear about missing the forest for the trees. But when you're picking stocks, it's just as important not to miss the trees for the forest. See, right now, when you look at the big picture, everything seems darn awful, doesn't it? We've got all these top-down analysts who see the debt ceiling fiasco as potential catastrophe. They see the mini-banking crisis as something that could be a true financial storm, one that didn't exist a few months ago, but snuck up on us. And now we don't know when it'll end. That's what all the bears keep telling me. From a big picture perspective, there's only one question. Why the heck aren't we going down? Why hasn't the market cratered? Even on a not-so-hot day like today, the Dow only dipped 56 points. S&P finished up 0.05%. NASDAQ inched up 0.18%, even though the talk shows this weekend were filled with gloom and doom. See, we just can't figure out how the heck this market keeps hanging in there with all this obviously troubling news that you and I know is what people talk about when the stock market comes up in conversation. So here's what I did. I decided to make it clinical. This weekend, I went over the charts to figure out every chart, to figure out what the strategists might be missing. And sure enough, I figured out why everybody's so darn confused. The winning groups do indeed make no sense. They aren't supposed to be up all at once. They're like oil and water, square peg, round hole, that type of thing. When you've got mismatched leadership, it's hard to make easy generalizations, which is what makes this situation so darn perplexing. But don't worry, we're going to straighten it all out. When you look at what's working, it is certainly a conundrum. First, industrials continue to do no wrong. Take one look. It's Eaton, one of the best performers. Air Products, Honeywell, Deere, Johnson Controls, Cummins, Rockwell Automation, General Electric, Parker Hannifin. These just jump out at you as stocks that can't be stopped. How the heck can the industrials be such terrific leaders after the Fed's raised rates by 500 basis points in just 14 months? It's simple. For the most part, these companies are involved in aerospace or decarbonization, or both. While aerospace is a cyclical industry, it's levered to the aerospace cycle, not the typical business cycle. When aerospace catches fire, it can keep burning for years and years. This current upcycle may turn out to be the longest one in the history of the industry because there's just so much pent-up demand. Remember, there are only two large-scale commercial aircraft manufacturers, Boeing and Airbus, and both of which have far more orders than they can handle, even though Boeing's had so many problems. I expect to hear about a huge Boeing order soon from Ryanair, which have been critical of Boeing's deliveries right on our air. But where else are they going to go? I mean, when Airbus has an even longer wait? If you're a supplier to Boeing or Airbus, like General Electric, your charts, wow. I mean, they're just... It's nothing but orders, which means 52-week highs for all. Then there's Cummins, run by Jen Rumsey, who was on our air not that long ago, who's taking her engine company out of the dark ages of diesel into the bright future of the hydrogen economy. Okay, I know there's nothing available right now, but Cummins is working on hydrogen-powered vehicles and producing electrolyzers, the big-ticket pieces of equipment that actually make hydrogen. Cramer fave Linde, we own that for the Charitable Trust, just selected Cummins to supply an electrolyzer for one of their new hydrogen plants. That's not what we normally expect from an old-school engine company. But in a world where there are tons of mutual funds that need green industrials, I think Cummins is among the best, possibly only rivaled by Eaton. Boy, I wish they'd come on air. They've got this power management solutions business that can reduce your carbon footprint, and it's extraordinary. And talk about being caught up in charging of electric vehicles. I mean, that's Eaton. I think the long-term stories of aerospace, clean power, and power management confuse the heck out of the top-down strategists because they keep working regardless of what the Fed's doing. But the industrials supposed to be falling here. But you can't pigeonhole the industrials anymore as you would have in a pre-decarbonization era. By the way, whoever even knew what the decarbonization term meant just 5-10 years ago. Now, the second most confusing segment, and this one's really got people confused, is housing. Lennar, Pulte, KB. I could have put Toll Brothers up here, too. Frankly, D.R. Horton I could have put up. Any one of those. D.R. Horton's also I should have put up. These are some of the strongest charts in the book. Historically, these stocks should be at their 52-week lows, not highs. I felt like I was looking at the chart book upside down because when the Fed raises rates aggressively, these stocks are supposed to get hammered. So what gives? It's simple. There's a tremendous housing shortage in this country. People are fleeing the cities, bolting from the Northeast, heading to the Southeast at unprecedented numbers, upended by tax considerations that we never thought about before. Meanwhile, the days when housing developments can just appear are long gone. Zoning, planning, density, these are all impediments that have no quick fix. The Wall Street Journal suggests that there may be a shortage of between 2 and 7 million homes. I know that's a wide variation, but it does mean that there's many years of earnings growth ahead for companies that used to be cyclical. Again, that's not supposed to be what happens. Short-term rates are skyrocketing. But guess what? Here's an oddity. Long-term rates, okay, they are coming down because everybody's afraid of recession. And that makes mortgages cheaper because mortgages they're priced off the 10 or 20-year mortgage. That 20-year long bond. So suddenly, we've got this weird anomaly where the Fed's raising rates and the mortgage rates are coming down. Plus, the home builders raised price by a gigantic amount, roughly 25% on average in the last 2 years, in part because of supply chain woes that have already been solved. They're not passing those savings on to the customers, though, because demand is so strong they don't need to. So we've got many industrials. We've got the home builders. These are leadership groups you typically see during an economic expansion, not leading up to a possible recession, like the longer-term bonds are saying must happen. But then you look at the other leaders, and they don't fit the bill either. I mean, healthcare. Okay, healthcare's running. Those are classic slowdown stocks. They shouldn't be running at the same time as the industrials and the housing stocks. The drug names are in fuego, led by Eli Lilly, Novo Nordisk, Merck, and Vertex, which are all enjoying new product cycles. Lilly and Novo Nordisk have diabetes drugs that could be revolutionary weight loss treatments. They would be going up under a strong or weak economy, so they're not so anomalous versus the industrials. And then there's the emerging turn in medical devices, including Abbott Labs, Intuitive Surgical, Medtronic, Edwards Life Sciences, ResMed, which we had on the show last week, Stryker, which we have on later tonight. Why medical devices? Because so many people deferred non-urgent surgeries during the pandemic that demand has now come back with a vengeance. Post-COVID stocks, not economic cycle stocks. Then, of course, there's another one that's just so hard to understand. The travel, leisure, and entertainment stocks. I mean, this group should be just being crushed by higher rates. Nope, they're on fire. Again, because of pent-up demand. You see big gains in Darden, that's the parent company of Olive, Chipotle, Cheesecake Factory, not to mention Delta, American Airlines, Royal Caribbean, Marriott. The top-down strategists know in their bones that these stocks should be flat on their backs right now. Instead, they keep roaring because we're in a weird post-pandemic moment where everybody feels long on money and short on time. So these stocks, which would every one of these would be crushed if we're about to go into recession, instead are just like American Airlines, just starting to turn up. Just like Chipotle just reported good. Royal Caribbean finally caught fire just last week. Another good day today. But then the consumer packaged goods stocks are flying too. That's a conundrum, which is what you think should be happening when we're going into recession, but not against what we had before. Campbell's Soup, General Mills, PepsiCo, Procter & Gamble, Colgate, Conagra, they all look great right now. Of course, you have to wonder how much of their strength comes from the earnings boost they get as their costs come down while their prices stay the same. Yes, they boosted prices when commodity stocks went up, but they aren't cutting prices with commodities coming down, and that's a huge part of their surge. Finally, there's tech, which is confusing everyone. It's actually big cap tech, really. NVIDIA, Meta Platforms, Microsoft, and Apple, leveraging Broadcom Analog Devices, Alphabet, and Amazon. How is this possible after 500 basis points of rate hikes? Technology always gets crushed here. These are usually the first to fold. But now they've got some special things going for them, and they've got things like artificial intelligence. Now, nothing the Fed does will stop the growth of AI for NVIDIA, for Microsoft, for Alphabet. No way. Not when we have Meta. Meta is deep in the AI world. That's a lot of what's going on with Instagram, why they're doing so well. These companies you could double interest rates. I'm not sure some of these companies would stop. Individually, you can make the case for any of these groups, but collectively, the mosaic doesn't seem to make any sense, right? Industrials pair with healthcare, packaged goods with housing, travel and leisure with big pharma. It's insanity for a top-down strategist. But it all makes perfect sense if you're focused on individual stock picking, which is what our show's about. Bottom line, you just heard why I think the vast bulk of bear strategists will be wrong this year. They refuse to get into the weeds of individual companies where everything counts. They're stuck at the top looking down, but the interest can only be found at the bottom looking up, because that's the only way anything in this market makes sense. Let's go to Jerry in New Jersey. Jerry.
Hey, thanks for taking my call, Jim.
Of course, Jerry.
I wanted to know I'm a loyal fan. I love your show. I can't thank you enough for the ongoing insight you provide investors. So here's my
thank you. Thank you, Jerry. I appreciate that.
My pleasure. Here's my question. Over the past 12 months, Newell Brands has fallen 50% in value, yet management has succeeded in maintaining the dividend. My question is twofold. First, in your opinion, do you think the dividend is sustainable? Secondly, do you think this stock is a buy, hold, or sell candidate?
Okay, it's a great question. The stock's down 22% this year. I do question the dividend. I question the cash flow. I look at Ollie's, by the way. I'm a member of Ollie's Army. Boy, there isn't a week where Newell stuff is not for sale. Really, really for sale. I'm very concerned about Newell. Let's put it that way. I'm very concerned about it. I just don't know if they have the staying power to keep that dividend. Right now, there's an unconventional group of industries that are working to keep the market afloat. And it's a recipe for success for all the stock pickers out there, even as it confuses and confounds the top-down strategists. Well, Mad Money tonight, how should investors interpret the post-earnings volatility of stocks like medical technology company Stryker? I'm checking in with the CEO. Then last year, we ran through the professional sports stocks. You loved it. The ones you can own a piece of course. So we're revisiting the names we like to see if any of them could continue to hit it out of the park. And is it time to turn to a steady Eddie utility like Exelon amid economic uncertainty? I'm getting the latest from the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.